What's your credit score?
785.
590.
I'm like 800.
6 something.
748.
I don't know.
No idea.
I've never checked.
When was the last time you thought about your credit score? Maybe it's haunting you like a shadow in the back of your mind, or maybe you've convinced yourself it doesn't matter at all. Either way, our credit scores are like an invisible hand guiding some of life's biggest decisions. But here's the thing. For every piece of good advice, there's a mountain of myths. And today, we're cutting through the noise and shining a light on the truth behind 10 of the most common credit score myths. Welcome to Ivory Finance, a place where we show you the road when it gets tricky financially. Before we dive into the credit score myths, let's talk about what a credit score really is and why it holds so much weight in your financial life. When credit scores were invented just a few decades ago, they were hailed as a way to democratize lending, play down human judgment, and let computers make most of the decisions. Today, AI makes the most of lending decisions. Nearly everywhere in the world today, credit scores have become essential. Not having one can basically lock you out of daily life, and a low score can make life difficult too. So, how did we get here? What exactly are credit scores, and why do they keep so many people from accessing what they need? A credit score is essentially a 3-digit number that represents how creditworthy you are. It's calculated based on your financial history, things like how you handle debt, pay your bills, and manage credit cards or loans. For lenders, it's like a snapshot, a quick way to gauge the likelihood that you'll pay them back on time. The higher your score, the more likely you are seen as a safe bet. But where did this idea come from? Let's rewind a bit. The concept of credit scoring goes back to the 1950s, a time when credit decisions were far less objective. Lenders relied on personal opinions and sometimes biases to decide whether someone was worthy of a loan. There wasn't a consistent, fair system to determine this. That all began to change in 1956 when two engineers, Bill Fair and Earl Isaac, created Fair, Isaac & Company, today known as BICO. They developed a standardized scoring system based on real data and algorithms to make credit decisions more impartial and reliable. Over time, this credit scoring model spread, and in the 1980s, FICO scores started becoming the standard for most lenders across the US. In recent years, we've also seen VantageScore, launched in 2006 as a collaboration between the three major credit bureaus, Experian, Equifax, and TransUnion. VantageScore was designed to be a more inclusive scoring model, especially for those with limited credit history. Today, credit scores are central to nearly every major financial decision we make, from buying a house to even renting an apartment. And with digital data and AI, the systems are getting even more sophisticated, pulling in broader data sources and offering more real-time updates. So what does all this mean? Credit scores have come a long way, but they're still often misunderstood. That's why we're here, to break down the myths and misconceptions that might be holding you back from a healthier financial life. Let's dive into myth number 1. Myth number 1. Checking your credit score lowers it. You'd be surprised how many people believe this. In fact, a 2015 LendingTree survey found that nearly 60% of Americans avoid checking their credit score because of this fear. Now here's the reality. When you check your own score, it's known as a soft inquiry, and it won't cost you a single point. But if a lender does it when you're applying for credit, that's a hard inquiry, and yes, it can nick a few points off. So remember, curiosity doesn't kill your score. Myth number 2. All debt is bad for your credit score. This one is as misleading as it gets. Debt isn't inherently bad. It's all in how you handle it. Not all debt are bad, and in fact, managing debt responsibly can actually improve your credit score. Let's break it down with an example. Imagine you have a credit card with a $10,000 limit and you owe $2,000 on it. That means you're using 20% of your available credit. Financial experts recommend keeping your usage below 30%. So, by not maxing out your card and keeping your balance low, you're showing that you can manage your debt well, which helps improve your credit score. Myth number 3. Closing old accounts helps your score. It's easy to see why people think this. You're cleaning house, right? But in the world of credit, closing old accounts can actually hurt you. Your credit score partly depends on how long you've had credit. Let's say you've had a card for 10 years. That's history you want to keep. Closing it cuts down your average account age and may decrease your available credit, which can hurt your utilization rate. So before you close that card or bank account, ask yourself, is it costing you anything to keep it open? If not, let it stay. After all, an old friend is better than a new enemy. Myth number 4. You only have one credit score. Here's a shocker. You don't have one credit score. You've got several, and they can all look different. Each of the three major credit bureaus, Experian, Equifax, and TransUnion, uses slightly different information and scoring models. Even the score models differ. There's FICO, which 90% of top lenders use, but there's also VantageScore. While FICO rate, often used by Experian, rates your 670 to 739 score as good. Vantage, often used by Equifax and TransUnion, rates your 601 to 780 as good. So if you're scratching your head trying to figure out which is your real score, don't sweat it. Just aim for a consistent range across the board. Myth number 5, paying off collection accounts immediately removes them from your score. Myth number 5 can feel like a sucker punch. Pay off a collection account, and it'll vanish from your credit report. It makes sense, right? You settled the debt. But here's the cold truth. Even after paying, that collection mark can hang around like a bad penny for up to 7 years. But don't let that discourage you. Paying off the debt still makes a difference to lenders and will look better than an unpaid account. As the saying goes, better late than never. Myth number 6, carrying a balance improves your score. Another popular myth is that carrying a balance on your credit card somehow boosts your score. Nope. Please note, a balance is simply the amount of money you owe to your credit card company, and if you don't pay it off in full, the interest charges can add up quickly. Not only does this not help, but it also leads you straight into the jaws of high interest rates. If you're able, paying off your balance each month is the best move for your score and your wallet. This way, you avoid paying interest and keep your credit utilization low. In this case, a penny saved really is a penny earned. Myth number 7, your income affects your credit score. Here's a surprise for many. Your income has no direct effect on your credit score. That's right, whether you earn $20,000 or $200,000, it's all about how you manage your credit, not how much you make. Your score is based on credit history, payment behavior, debt levels, and other factors. So remember, even with modest earnings, good credit habits can lead to a strong score. Myth number 8, using debit cards builds credit. Let's clarify another big one. Using a debit card doesn't build credit. Since debit transactions aren't credit-based, they don't report to credit bureaus. It's only loans, credit cards, mortgage, and credit accounts that impact your score. While debit is great for day-to-day spending, it won't boost your score. Want to build credit? Start with a secured credit card or consider a small credit builder loan. Myth number 9, credit counseling will hurt your score. Another myth that causes needless worry. Credit counseling will tank your credit score. Let's set the record straight. Reputable credit counseling won't impact your score, and it could even help you get back on track. Credit counseling agencies work with you on budgeting and financial planning, which doesn't impact your score. Only debt arrangement programs have the potential to influence it. Myth number 10, bankruptcy will ruin your score forever. And lastly, the big one, bankruptcy. Now, bankruptcy can be a serious blow, but it's not the end. Within a year, you can start rebuilding your score with good habits. With time, the right strategies, and patience, it's possible to bounce back. Just remember, Rome wasn't built in a day, but with steady effort, you can rebuild your credit. If you have watched this far, it really means you are set to make better credit decisions in the nearest future. Visit our website on www.ivory.finance to access credit building tools and resources. We have packaged our 16 years of collective experience into hardcore personal finance advice, just for you. All right, here's a quick recap of the 10 myths we busted today. 1. Checking your credit score will not lower your score. 2. Not all debts are bad for your credit score. 3. Closing old accounts won't help your score. 4. You can have more than one credit score. 5. Paying off debt does not instantly erase it from your credit profile. It could take longer. 6. Carrying a balance will not boost your score. 7. Your income has no direct correlation with your credit score. 8. Debit cards will not build your credit score. 9. Credit counseling will not affect your score. 10. Bankruptcy will not ruin your credit reputation. Hopefully, you're feeling a little less in the dark about your credit score. Let's continue making informed choices and break free from these myths. Hit that like and subscribe if this video helped shed some light.